Good morning. My name is Rob Bauer. I'm a professor of finance at Maastricht University, and I was kindly invited by Ben Caldecott to moderate this panel. This panel has a very long title. I'm not going to repeat it, but it's obviously that the Exxon case is sort of a trigger for this panel, and maybe also last year's panel on the topic, moderated by Bob, if you remember. So what is the future of stewardship and engagement is the key topic here, and the Exxon Engine No.1 case is a great case to look back at and to see whether we've learned something about what happened there. So the key questions we will discuss here are: what are the objectives of engagement? Which dilemmas and trade-offs do asset owners, asset managers face when they start engagement campaigns? And how to measure whether engagement is successful? What do we do when it fails, etc. What we're going to do differently is that we're going to have really short introductions, and immediately after that I will ask one or two questions to the panelists, but we also would like you to be engaged in this session. So I will stand up and walk around with my mic, give me a hint that you want to ask something, and then we're going to get a real debate. Unfortunately, we only have 75 minutes, and we have, let's say, a list of questions for 3 hours or so. And you probably also have a lot of questions. So in order to determine which questions are important, I really need you, because you can ask them. The speakers in this panel will share their background briefly, but of course they have way more to say, so that's when your questions can come in. When you ask a question, and I've seen it yesterday, concise questions, you can also give a comment, even shorter comments. And if not, I interrupt you, then you already know that. Yeah, so that's the plan. Before we start, I'd like to already introduce, so that we get the flow, the speakers. We're going to speak in the order of first Geraldine Leegwater, who is the Chief Investment Manager of PGGM, the Dutch Healthcare Pension Fund Delegated Asset Manager. Is that the way to say it? Probably. Then there's Laura Hillis. She is the Director Climate and Environment on Responsible Investment of Church of England, Pension Board. Then Catherine Howard, who is Chief Executive Officer of Share Action. And we end with Lindsay Stewart, Director of Investment Stewardship Research, Morningstar. So as you can hear, we will have asset owners on the table. We got an NGO type of organization on the table, but we also have a commercial organization like Morningstar that will look at all the asset managers, what they're doing, so we can ask questions in multiple dimensions. So with that, I turn over to Geraldine.
Yeah, thank you very much. 5 minutes to give a short introduction and to already highlight the 4 questions that you wanted to address. So in our case, what's our objective? Well, to start with, we have an obligation towards participants in the scheme. An obligation to be an active shareholder and being deliberate about what we're doing with their money. So that's the first and an important objective. In addition to that, engagement can lead to an improvement of the financial standing of companies. So it's important, but it's not for certain that we will achieve that. And the last one, engagement can lead to real-world impact. And also with that one, I say on purpose, can lead, because we have to experience whether that will work out. Well, how do we do that in practice? We have a major investment portfolio, and therefore we have to be selective, and we have to be very concrete on what we're doing with the resources we have. So we have 2 main themes. First of all, the health and welfare sector, because of the background of our participants. And secondly, it's climate and nature, because of the importance of this topic. And in addition, we can do thematic engagement. We should distinguish reactive and proactive engagement, and I think the topic for today is more the proactive engagement. So let's elaborate more on that one. And how do we do that in practice? We learn more and more that we have to set incredible concrete goals, and they should be of importance for the company and for society. And that sounds easy, but in practice, I'm sure we're going to debate that, is not so easy. So be concrete and set targets and set also timelines. And then probably the more important one to have the debate on, well, what did we learn so far and what are the dilemmas if you just phrase what I just phrased, which sounds very easy. Well, first of all, we need cooperation. It's not only with other asset owners, it's also within our own company. It can be that the incentives of the more RI incentivized people, that they have different views compared to the more traditional portfolio managers. So let me be clear about this dilemma. We face that in our organization as well. Another one is we see a lack of cohesion among investors. Even if we cooperate together with other asset owners or sometimes also asset managers, we see that we're not always on the same page. And what we also see is, to be successful, we need sufficient resources, we need people who understand the topics and what's going on, but also data, systems, etc., etc. If we want to bring this to the next level, and we consider this important, these are issues that we have to further address, and we can learn from what we experience so far. And then 3 key messages, hopefully for the debate as well. Well, investors, they should put their votes also to where their mouth is. Collaboration is key, and last but not least, effective engagement, and especially when it comes to climate, where we have, of course, major examples, it can be tackled with all key stakeholders. We should not just address the supply side or the companies, it should also be the demand side, but also policies around. And with that, I'd like to hand over to the next one.
Perfectly in time. Laura, you're next.
Thanks, I'll try and keep it short as well. So I'm at the Church of England Pensions Board, and we're a relatively small pension fund, but have quite a long history of acting on climate change. But also my background is I was one of the first staff who worked on Climate Action 100+ in Australia, and was part of building that up, setting up engagement groups, engaging with the companies in the initial phase of CA 100+. So I think my comments today will probably draw on a bit of a combination of both of those. So I thought I'd start by talking a little bit about kind of where we've gotten to with oil and gas engagement as kind of the stewardship RI community, where we are now and where we need to go from here. I think the first thing I would say is I think where we got to with oil and gas engagement over the last decade is extraordinary, really. It's not enough. We're not aligned with Paris. There's still an enormous way to go, but it is extraordinary. I remember sitting in with a group of Australian investors in 2018 and saying to them, what about scope 3 emissions? What about net zero targets from these companies? And investors said to me at the time, A, we're not looking for that, and B, it's impossible. It is clearly not impossible. So we came quite a long way. I also remember talking to oil and gas companies at that time and having them say to me, climate is not a risk for us, it's a risk for thermal coal producers, it's not a risk for us, it's a PR issue. So the fact that we now are in a situation 5 years later where many of these companies have put out transition plans, many of them have net zero targets, and they are incorporating climate change, is extraordinary progress. And I think we owe that to a combination of initiatives like CA 100+, investor action, civil society has been a huge part of it as well, but also, the policy developments as well. So I think there's a range of factors there. But where have we gotten to? I think there was a lot of action in 2021, and I know you're planning to talk about that a bit in your comments as well, Lindsay, around there was more support for shareholder resolutions. I think civil society had done a great job as well of filing really supportable shareholder resolutions and working with investors. We had what happened at Exxon Mobil happen around that time period. There was a lot of progress, and it didn't feel like we had, gotten somewhere necessarily, but it felt like we were in a position where the work was beginning and it was serious and it was real and it was genuine. That's how I felt. And cut to 2023, I don't feel as optimistic as that anymore about engagement with these companies. I think, we've seen backtracking, we've seen probably less support for some of those shareholder resolutions now in this proxy season than we saw a few years ago. So we're starting to see kind of a more mixed picture emerge. And that brings me to the Church of England Pensions Board's recent decision to divest from the oil and gas sector. And I'll just briefly say, how that happened. So in 2019, we set out a 5-year engagement program with the oil and gas sector, the companies that we owned in our portfolio. We set very clear time-bound targets and expectations of those companies. We communicated them clearly and consistently at all levels of the business, including to board members. We escalated where we felt that the companies weren't making sufficient progress. We excluded where companies missed hurdles that we'd set for them. And we also supported companies where we thought they were making sufficient progress, but continued to press for more because we had high expectations of these companies. We had hoped that what would happen at the end of that process is that there would still be some companies that had demonstrated independently that they were Paris aligned in terms of their emission reduction targets and transition plans, so that we could remain invested. Unfortunately, that was not the case. We had set a really high bar for this engagement, and when we did the assessment earlier this year, we found that there were no companies in that potential investment universe that were aligned with the Paris Agreement according to the standards that we had set. And that influenced our decision to divest. And so that brings me to what happens next. There's a couple of things that I would say. Fundamentally, there are governance issues at these companies that have been there for a long time and they remain. So for the investors who are still invested, that's obviously not us, but robust engagement, clear engagement with these companies clearly needs to continue to happen. It needs to escalate where companies aren't aligning with what investors want. And I really think, fundamentally this is about board accountability. The boards, the leaders of these companies need to be held accountable for the direction that they're taking the companies in. I think there's a few other things though. Value chain engagement is really important. It's fairly well on the public record now that we're focusing on demand side engagement, so we're going to be looking at eroding that demand for oil, gas, thermal coal to get the economy on that path to transition in line with a 1.5 degree outcome. So that is going to be our focus. Financing from banks is super important as well. So this is the full value chain engagement. And then the last thing that I would say is policy. And I hate saying it because in the responsible investment industry, I feel like we have a bit of a habit sometimes of going, the policymakers need to fix it. And it's true, right? We all know that that is what needs to happen. But I think there aren't a lot of actors out there in the economy that are making a rational case for why it is economically sensible to align with 1.5. There are a lot of actors out there that are saying we should delay, we should slow down. There's a lot of lobby groups doing that. But I don't know that the responsible investment industry is doing enough to say to policymakers, this is why we need to align with a 1.5 degree outcome. So I would put that as the challenge to everyone, that it's value chain engagement, it's escalation with companies, but it's also about how much are we making the case to policymakers that we actually need this 1.5 degree outcome for the economy, for our beneficiaries, but for the long-term health of the world we live in as well.
Thank you, Laura. Keep your enthusiasm contained. Catherine, unleash it when you want to ask a question later. Catherine.
Thank you so much. Before I start my remarks, I really want to applaud the sort of intellectual coherence of what the Church of England has done in terms of setting clear long-term objectives and making them public and then acting on them. It's just such a tremendous model. Although I would challenge the idea that we've made tremendous progress with all this engagement when you actually had to divest the entire sector. It rather suggests we didn't make such tremendous progress with our engagements. Anyway, I'm from Share Action, and we are a not-for-profit organization that tries to define the highest standards for responsible investment practice and encourage investors across the world to adopt it. And in order to do that, we're involved in a whole range of real engagements in different sectors where companies are producing impacts which we think are detrimental to the welfare of pension savers across the world. So our kind of underlying rationale is that all investment decision-making undertaken by fiduciaries, in other words, on behalf of someone else, should be guided by maximizing the welfare of those underlying beneficiaries. So that definitely means securing them an income in the case of a pension fund, but where the income is generated in a way that produces negative impacts on the world that undermine the welfare of those beneficiaries, it needs to be calibrated. So we understand in the investment world about risk-adjusted returns, but we haven't yet fully acknowledged the need for impact-adjusted, risk-adjusted returns, because that is what would really, I think, deliver the kind of world that people want to retire into and deserve. And at the moment, the climate crisis is obviously the most high-profile example, but only one of the ways in which fiduciary investors are invested in companies that are seriously damaging the long-term security, welfare, and interests of people whose money is being invested by those fiduciary investors. Anyway, a few quick thoughts on what I think is the future of stewardship and engagement. So firstly, I think it's about having this clarity on objective, that the objective should be maximizing the welfare of the beneficiaries to whom you owe duties to act in their best interests. Secondly, it's about collective action and collaboration. And I really want to hold up as great examples Climate Action 100+, GFANS, all of the efforts to bring investors together to do things collaboratively are critical. Like, in a world of highly diversified portfolios and institutional investors that hold a little bit of that and a little bit of this, in common with lots of other investors who hold a little bit of that and a little bit of this, we need to collaborate. So that's really central. Then I think there's also a piece around kind of plugging together capital allocation decisions and stewardship decisions. And I actually really I think the Church of England is a lovely example of this. So I think institutional investors should over-allocate capital to companies that are really making a transition, but over-allocate stewardship resource to companies that are able to make that transition but aren't willing to, and really use those forceful escalation tactics to move corporate boards to make the commitments to, let's say, net zero aligned transition plans. And then under-allocate both capital and limited engagement resource to complete laggards. And again, I think so that creates clarity on the fact that there are some holdings that you shouldn't hold in your portfolio. And I think, by the way, PGGM and Church of England, both really good examples of having divestment part of a coherent, intellectually consistent approach to thinking about where do we allocate capital and where do we allocate stewardship resource and where do we not bother with either because those companies aren't able or willing to act. And then I think it's about resourcing this appropriately. So stewardship is really labor intensive and it requires great skill. So a little plug is that Oxford Sustainable Finance Group and Share Action will be putting on an amazing 3-day stewardship executive education experience in June of next year. So if you want to build your stewardship skills, come and join this course because it's going to be a really brilliant forum, I hope, for acquiring the skill required not only to negotiate with your fellow investors to achieve really clear objectives for your stewardship, but also, of course, with the corporate boards, because these are really skillful negotiations that take place. And the idea that, you know, you can hire a really junior analyst and just throw them in to engage with the board of one of the world's largest public companies, we need to really invest in fantastic people like we have on the stage to be the skilled executives that lead stewardship work. And then rigor and transparency around evaluating outcomes, because again, being really honest about, and again, I really applaud the Church of England on this, being honest, we didn't make it happen. Being clear and honest, rigorous, transparent is a really big part of what I think the future of stewardship engagement will look like.
Thank you, Catherine. Lindsay.
Thank you, Rob, and great points made by all of the panelists. So we gathered here, and the title of the talk was, it referenced Exxon and Engine No.1, which occurred in 2021. Now, a lot of things happened in 2021, and I think there's a nice symmetry that at the start of yesterday, we looked forward 2 years to 2025, and now we're looking back 2 years. 2021 was unusual in a lot of ways. Now, obviously, it was the middle of a global pandemic. Are we in lockdown? Are we out of lockdown? And I think a lot of people kind of took decisions that suggested that they'd forgotten what the real world actually looked like. Bob Eccles yesterday talked about the big bet that the financial sector is going to lead the transition, and that's a great way of putting it. We had COP26, people meeting in person, maybe for the first time. In the UK, there was lots of financial representation at the table. Maybe some groupthink emerged on what finance was capable of doing and what stewardship can and can't achieve. At Morningstar, we're taking a look at the proxy voting data on key shareholder resolutions. We do that every year, and we've done it for the last 3 years, and we've seen some interesting patterns. Around the 2020 proxy year, we saw about 1/4 of shareholders in the US, where 75% of these resolutions happen, supported resolutions that dealt with key environmental or social topics. That tipped up to around 1/3 in the 2021 proxy year when all of this was happening. It looks like it's dropped back again in the last 2 years. So in 2022, dropped back to around 30%. I'm expecting similar numbers this year when that analysis is complete. So we saw that peak around, the Exxon Mobil engagement, around COP26. That peak is repeated across all of the data we see, whether it's for aggregates of the entire market, whether it's for individual managers or groups of large asset managers. There seems to have been a bit of a pullback in the support for these resolutions. There are a few factors that go into that. Some of it is the climate, particularly in the US, the ESG backlash that we've all heard about, has affected the way some people look at it. But there's also been an increase in the number of resolutions making very, very specific asks. A lot of asset managers have pushed back on that. A lot of asset owners are backing those things. But it's clear that there is a bit of a dichotomy between the way that asset owners are thinking over multiple decades versus asset managers, who are themselves companies thinking over multiple quarters, if you're lucky. So 2021 was definitely an important year for stewardship, and I think the success of replacing board directors at Exxon was a good illustration of that. But it also helps illustrate the limits that stewardship was very much, as we understand it, stewardship was very much designed for governance issues, for dealing with board directors, with shareholder rights. And we've very rightly extended those principles into environmental and social topics in areas which are technically difficult, have social impact, have huge ethical considerations, and it's much harder to find consensus on what right looks like amid various regulatory regimes that prioritize the needs of different stakeholders. And since the enthusiasm that we saw around COP26 in 2021 for committing to environmental and social sustainability, we've had lots of consultations that have forced asset managers, asset owners, lots of financial actors to become very specific about what they meant when they said that. Examples being the SEC's climate rule, the ISSB's proposals. Lots of questions being asked, what do you think on materiality? Should it be all stakeholders? Should it be investors? Should it be just shareholders? What do you mean by that? Same with Scope 3 reporting. Are you prepared to live with the uncertainty of the estimation that is required to give Scope 3 reporting? Those kinds of questions are starting to fragment the coalitions of asset managers on what their actual environmental and social objectives are. So, just to conclude, does that mean that stewardship is ineffective? No, stewardship is great at achieving very specific goals, often at companies, sometimes at sectors, if people collaborate effectively. But the idea of taking the oil industry as an example, that stewardship can somehow displace a sector that is causing a degree of harm, particularly in the climate area, but is intrinsic to the economy. That certainly is the role of policymakers, of governments, of supranational organizations. And it's like Laura says, there needs to be a bit more pressure put on those organizations to not throw everything in the investor's basket for them to solve, because there is a limit to what private markets can achieve, and really emphasize that governments do need to get a grip on this if you're going to replace that system of energy with another. So I'm just going to conclude there and allow everyone else to comment. Thank you.
Thank you, Lindsay. So, as promised, can you please put the mic on? As promised. Well, I'm going to first ask one question. Is that okay? I know. Yes. Okay. So, my first question to the panel actually is the following, and I start with Geraldine. So you have a mission as PGGM that says we want to provide really good pensions in a livable world. That's essentially what you say, which shows the two objectives that your fund has. Sometimes those two objectives are consistent with each other, to maybe take into account climate risk in your portfolio is a good thing, but it also contributes to a livable world. So my question to you is, how do you deal with this challenge if there is maybe an objective that does not necessarily lead to a better risk or lower return, or better return or lower risk in your portfolio? How do you deal with that, with that dilemma?
Yeah, that's certainly a dilemma in a changing world. I think it's gaining more importance that we should focus on outcome goals as well. And if you look at our perspective, we want to do that from the complete investment portfolio, which implies that if you do individual investments, you still might have investments in the portfolio for, one or two objectives. So it's not the case that each individual investment should contribute to all three at the same level. And we do believe that if you build a total portfolio and you set certain concrete impact goals, that you will be able to build such a portfolio. And in our case, if it comes to those type of impact goals, they will be related to the social and healthcare sector that I was referring to. And what's important to mention is we talk a lot about climate and the importance of climate risk. And I think that's a different topic if it comes to impact goals. We do believe that when it comes to climate, we're very close to the situation that basically that's an unaccepted systemic risk. That's basically a given that we have to deal with. And then if you think along that line, then it's no longer the question of whether you then have to sacrifice return because, for example, certain elements in your portfolio, you don't want to have them anymore. It's basically a matter of the system that you have to deal with. And of course, then there's still a time horizon that you might have just financial investors who look at a short horizon, but we do believe that that's a system risk that you have to incorporate in your portfolio, and the question on whether that's sacrificing returns or not over the long term is not the right question anymore.
Thanks. Laura, I think the Church of England is even more explicit about that. And actually, Catherine, what you said, welfare is important similarly. So do you have anything to add to this? How do you choose between all those objectives that you can have, both in the space of the, let's say, the non-financial issues, but also the link with the risk and return dimension that you also have? You also have to provide pensions. So how do you have one portfolio and two objectives? How do you do it?
I mean, I think the objectives are the same, right? So I'm not that young, and I'm going to be retiring in the 2050s. You know, 2050s are going to look very different to how they're going to look today. So if you're my pension provider, then you need to be thinking about both giving me a decent retirement, which I hope I will enjoy, and secondly, the world that I'm going to retire into. So I do think that they are kind of two different parts of the same end. And the way we think about it at the Church of England Pensions Board is very much in the vein of systemic stewardship, for those of you who are familiar with that idea. And the basic idea of that is that economic volatility, economic risk, anywhere in the economy, if you're exposed to a lot of the economy, is going to be a problem for you. So rather than focusing, you know, in a very granular way on individual companies or individual assets, individual stocks, we look at the entire economy, we look at climate as a risk to the entire economy, and we think about how can we reduce that risk to the entire economy, because we know that what that will do is help deliver that long-term pension for our beneficiaries, but also, hopefully, it will help them to retire into a world that's healthy and has high levels of welfare and is a good place for them to retire into as well.
Okay, so Catherine, you then brought in the topic, but all those objectives you could have, all these topics in the welfare domain, you have to focus, or at least you have to resource it well, but you cannot resource everything well. So how do you do that, also in your organization?
So I completely subscribe to the idea that institutional investors need to be quite selective in their stewardship kind of domain of activities, because you can't do everything well. And as we've discussed already, you know, achieving really substantive outcomes through engagement takes a long time, takes a lot of resource, a lot of upfront research, a lot of discussion with other shareholders in the company. So you can't do everything. And I think what we really advocate is that institutional investors, particularly pension funds, have much more of a dialogue with their beneficiaries about what their priorities are. I mean, I think we can probably all subscribe to the idea that climate catastrophe is in nobody's interest. So climate should be a top priority and is a top priority for almost all pension fund investors that are sort of in any way coherent on these things. But beyond that, people will have different priorities. So I think public health and the health of your beneficiaries is a kind of very obvious priority area. You know, if your objective in old age is to have a decent quality of life, then companies that undermine your health are a problem. And I think those make a lot of sense to be in focus for stewardship activities. And we're working closely with a wide range of institutional investors on public health issues, looking at nutrition, looking at things like chemicals. I mean, chemicals industry is having tremendously damaging effects on the life of pension savers all over. Really scary results coming out about when we test people's blood and people's urine, it's full of chemicals produced by the companies in our pension funds. And there isn't really much of an engagement dialogue going on with that sector on that issue. So I think there's a lot of scope to really think, well, what are the stewardship issues that are really going to make a positive difference to the lives of the people whose money we're looking after? And then be really targeted, really focused, think about who else that makes sense for. So I think, you know, it makes an awful lot of sense for pension funds to collaborate on these health-related, both planetary health and human health. Just really obvious. Such good news for beneficiaries if we can nudge companies to be producing returns, but if necessary, calibrating returns maximization in order to achieve really positive outcomes that will make a big difference to the best interests and lives of our beneficiaries.
Thanks. So the resources, I guess, sorry to follow up, and maybe for all of you, you also have to choose who to collaborate with. How do you do that? That's quite a challenge. There are so many collaborative vehicles, and some of which, I mean, you mentioned also the Climate Action 100 with a lot of enthusiasm, but it is of course also a lot of asset managers in there that may have completely different incentives than you have. How do you deal with that? How do you choose who to work with? Laura, let's start there.
I have a cool answer to that, which is what we found with Climate Action 100 Plus when I was working on it is there's like a secret sauce to setting up a great collaborative engagement. And the secret sauce is having a combination of investors who are loud, that would be us, investors who are large, so typically have a large shareholding in the company, and investors that are local. So that's the 3 L's we used to say. And what you get in that engagement dynamic is you get companies who maybe know the local culture or language. This is particularly important if you're engaging in emerging markets. Who maybe have a long-standing understanding of the company. They might also understand the policy environment. You have someone who's willing to escalate. I mean, my opinion is more investors should be willing to escalate, but having that in your group, someone who's willing to go out on the public record and say, we are unhappy with the progress of this company, and we are going to do X, Y, Z, who are willing to hold them to account, who are willing to have engagement with consequences, that's really important. And then having someone who has that large shareholding, you know, we don't have huge shareholding, we're a small pension fund. So having asset managers in the team that do have those much larger shareholdings in the company can be really, really valuable. And I think where you have that group and what you end up with is a relatively consistent set of asks where you have kind of the whole investment sector kind of in the room and you're getting the same set of asks from that full group. That is really powerful engagement. It is not engagement that we could do on our own. And so I think the real power of CA 100 Plus, it doesn't always work perfectly, but when it does work well, it can be really amazing.
But again, you just divested fully from the oil and gas sector.
Yeah.
There's, yeah, so Geraldine, quick answer?
Yeah, a quick answer there. Yeah. We have 2 experiences, one with Climate 100 Plus, but at the same time we have an initiative just with a small group of investors very close to home. And I think if you see the differences there, on the one hand, a much bigger pile of investors, but probably not all of them, well, what I mentioned, ultimately put their vote where their mouth is. So you collaborate together, but ultimately you have no insight on what they exactly do, and the transparency is a bit limited compared to a smaller group of investors where you closely work together. I think we have experience with both of them, but I would not rule out the smaller group and be focused with a small group and be more outspoken.
So Lindsay, relatedly, I see a lot of asset managers especially, but probably also asset owners say, I'm not voting in favor of this file shareholder resolution because I also at the same time have an engagement program or something, that's the word they use, on the same topic. So you see then a lot of vote against certain resolutions, like very simple ones where they just demand Paris-aligned ambitions or whatever. So what can you say based on your data and the work that you did on this topic?
Sure, happy to talk about that. I'd say the resolutions that are requesting Paris alignment have actually had a greater degree of success than some of the more specific asks, for example, ceasing fossil fuel financing or underwriting that have come up more recently. But you're right, a lot of the times as an investment beneficiary, you might see a voting result and think that doesn't quite align with what I expected you to do. It's a complex patchwork. There are hundreds and hundreds of asset managers, each have their own engagement policy, their own proxy voting policy. They do outline exactly what decisions they're going to take. A lot of the time, increasingly, the best reporters are outlining exactly how they escalate and over what timescale they would do so. And so some will take the decision to support a shareholder resolution fairly quickly. Some will be slower about it if they're already having ongoing engagement. So what we do at Morningstar, we're very, very keen on just explaining exactly what that process looks like from one manager to another. Because when it comes to voting, basically you've only got 3 buttons to press, well, 2 buttons to press, or you abstain. And that doesn't necessarily capture all the nuance that goes into an engagement. It's important to check in aggregate whether the voting outcomes that you're seeing are in line with your own objectives, for sure. But a lot of the time, it's really down to the policies, the engagement reporting, the stewardship reporting, to really explain what those decisions actually mean. And for you to differentiate between what one asset manager has done on one particular resolution versus another, because they're not necessarily going to take the same decision, even if they've come to the same conclusion on those kinds of things. So it's becoming a more complex tapestry, but we're trying to pull the disclosures from all the various places where they exist and help investors understand exactly how those decisions are taken.
So the investors on the table, but maybe also Catherine, you had this great session in the Climate Action 100 Plus. You know, you sat at the bar looking back at the discussions you had with Total, and you agreed we're going to do this and we're going to put it really close to them. And then you also see that just one of your asset managers that was on that same table or on the same bar just voted against the resolution. Does that have an impact on how you further work with those asset managers? Is there any connection between what you observe in the engagement and voting arena on how you choose your asset managers, brokers, and other service providers in one way or the other?
Yeah, I think I was already referring to that one as a key message. It should be closer together, voting and engagement. And when it comes to selecting parties, in our case, we do provide mandates to asset managers, but we still follow our own investment policy. So that's, well, you could argue, okay, well, we follow our own policy. What do you think on the fact that they do something different? So far, that was not like an ultimate criteria not to work with somebody. But given the experience that we have over the years, where we should have more focus on how can we achieve ultimately the goals that we set, this all comes into the picture. When I mentioned you need the whole stakeholder field around you to become more effective, then it's no longer just a few people going to companies to engage. And then these type of questions should come to the table also with asset managers that you work with.
Laura or Catherine, who wanna?
I'd just add there's clearly a tension emerging here between the way asset owners are voting and the way, particularly pension funds, I think, because of that long-term view. And there is, I think, a view emerging that asset managers are simply not coherently voting in alignment with those best interests of many pension funds beneficiaries. And that's been on the public record. A couple of asset owners have spoken up about this and sort of said, you know, we need to engage with managers about this. But fundamentally, you vote with your feet. So I think once asset owners start to pull mandates from managers based on this, and that is certainly part of, we have an escalation framework with our own managers. If they're misaligned over a period of time and we aren't able to shift them, then that is part of what we will do. But once that starts to happen, I think on a big scale, I think that will start to hold asset managers more accountable. I know that's a slightly spicy thing to say, but I think that is the reality.
So we need a new term for divestment of asset managers. Asset management or something.
I mean, it's just, do you want someone managing your money for your beneficiaries that is aligned with your values? And I think the simple answer is yes, of course you do.
Catherine.
I could not agree more with that. I mean, trustees have an obligation to make all decisions coherently in the interests of their beneficiaries. If they've appointed asset managers who have a voting record that's detrimental to the interests of their beneficiaries, it's a clear breach of the legal duties of those trustees, and those managers should certainly be rigorously kind of hauled over the coals, but ultimately should be removed and replaced with managers that are committed to stewardship and engagement and voting that's clearly aligned with the interests of the underlying beneficiaries of the schemes.
Okay, so we're going to open it up now for the room, but I first was sort of ironically reminded of something that happened last year. I organized a conference in Toronto, a Texan trustee was talking about the responsible investment policy and said, we don't like divestment of oil, and that's why we exclude BlackRock. So they don't like divestments, and that's why they exclude BlackRock. Let's think about that further. But Alan, you have a question. Then there's a question over here after that.
Hi. So apologies for a slightly challenging question. I'm going to go back to CA 100 Plus for a second and just ask, so correct me if I'm wrong, but I don't think any of those companies is yet fully aligned with the transition. And I'd like to hear your reason, what do you think contributed to that fact and what could change? And actually, I'd like to cheekily ask if Rob could answer too, because you kind of hinted at what I think your answer is earlier.
Okay, well, okay. First the panel. You know, I'm just a moderator, Alan. Be careful. Who want to start?
I mean, I'm happy to start. I mean, I think the only answer that I have to that is clearly, as a responsible investment industry, we haven't succeeded yet. I mean, that is the simple answer to that. I think, you know, as I said at the beginning, I think there has been an extraordinary amount of progress. And it's partly, I know that you would disagree, Catherine, and I totally get where you're coming from. But I think it's also just that they weren't doing much, you know, at the beginning of that initiative. And I'm not saying that all of the progress from these companies can be attributed to CA 100 Plus. I don't think it can be. But I do think many of those companies have come a really long way. It's nowhere near enough. And I think that what that means to me is that as a responsible investor community, we have to get a lot smarter. We have to get smart with the resources we have. We often don't have a lot of resources for stewardship. We have to be strategic, we have to be thoughtful, and we have to do a lot more. I don't know that there's any other way of answering that, but I think, yeah, it's going to be continuing to roll our sleeves up and do the work and do really hard, tricky engagements and do them smartly and strategically.
Yeah, we're still in our program engagement with the oil and gas sector. It will run till the end of this year, then we'll make up our mind. But the honest answer is that indeed we're currently still engaging with only 12 companies left. So we made already a bit less than 200 divestments there, because we already saw they will never make the goals that we set. And well, to be realistic, it will probably a handful that will make it to our goals. It's unfortunate, of course, but while we set our goals and we have our targets, then ultimately, of course, yeah, it will be a divestment then.
I think it's worth asking the question, why are we convinced that oil companies can transition without being forced to by a government or a higher agency? Because even now, looking at, say, Exxon's latest earnings presentation, there's a slide in there that says it's an AND equation, meeting the world's needs, energy needs, through oil, I assume, and reducing emissions, as if you can really do both at the same time. That's 2 years after the Exxon Engine No.1 engagement. So, you know, these companies are run by oil guys, and it is normally guys, who've been in the industry 25, 30 years, who only know how to raise production, throw out cash, pay dividends, pay out buybacks. Why are we sure that oil companies are congenitally capable of doing anything else? I mean, the same way that Kodak knew that the digital camera resolution was coming, but they were a company that only made film cameras and camera film and were incapable of doing anything else. So just trying to understand that.
If I understand you correctly, essentially what the four of you say is we can better stop engaging with oil, use the resources maybe, first of all, to engage with maybe governments, policymakers, and with other pressing topics on the agenda. Catherine, I think you couldn't agree more again, isn't it?
Yeah, no, I do. So I think what we, Share Action 8 years ago was doing a lot of engagement with BP Shell. We filed for shareholder resolutions in 2009, but we just retreated from it completely almost over the last, and we keep a little bit of an eye on the sector because it's so critical to all of our collective outcomes. But we refocused our effort and our sort of engagement resource on the chemicals industry, which is a massive, hard to abate user of fossil fuel energy into the feedstocks, but also on the banking sector, because bank finance for new oil and gas, new production is a critical problem. But banks have loads of other industries that they support. And so it's really viable for banks to withdraw capital from the fossil fuel industry and still be a tremendously profitable concern and a successful industry. So I think, which, by the way, feels like quite a good match for what the Church of England is now thinking of doing. But I also think it's really important to highlight the tension between portfolio managers who get bonuses based on quarterly and annual outperformance against an index. In a year like 2022, when oil and gas stocks go sky high, you're in big problems as a portfolio manager if you weren't overweight oil and gas. It's just, so there are these horrible inside the system incentives which are highly misaligned with the long-term interests of beneficiaries. And I think it's really incumbent on the whole industry to try and get a bit coherent on that picture.
Okay, over there.
Thank you. Yeah, it's working out. So my name's Piers G. Smith from Franklin Templeton. I want to, well, firstly, thanks to the panel for your insights. It's been fascinating. And I think I also particularly want to thank Laura for flagging the systemic stewardship topic, which I think is an excellent one. And I also want to thank you for highlighting the dual purpose of pensions so clearly, to provide a real-time base income in real time to their beneficiaries, but also protect the system's future health so that income can be fully utilized in time. And I want to draw a parallel to the oil and gas sector and ask the panel about how you deal with this mixed incentive problem that Catherine touched on, which is you have an industry that is in long-term structural decline, or certainly by our own stress testing and climate modeling, you would view it that way, but is in the short term putting out very, very strong free cash flows that are supporting base incomes for portfolios and beneficiaries. And so how do you, as a fund manager, reconcile that clash in incentives of delivering your real-time requirement to deliver base income and protect the systemic health, both of which are very important factors to your dual purpose as a pension fund?
Well, maybe a comment here to your question, but also what was raised here around the table already. What are the incentives within our organization? Because you're completely right. If we don't change the incentives and the traditional portfolio managers, then this will not go hand in hand. So the initiative that we have is that indeed the traditional, financial results that you basically pass on to your portfolio manager, that should be changed as well, because otherwise they do face the dilemma of the end-year meeting where we ask them, well, you have an under or outperformance, and what happened? So we are on the way that we first of all set all the targets for a much longer horizon. They should be in line with basically ultimately the long-term investment portfolio. And the other one is that they should not just have those financial targets, they should have the impact outcome targets as well. And of course then you get the debate, but what is an exact target, how do you measure it, etc., etc. It will not be perfect in the short run. We will change it over the years because this is an ongoing journey that we're on, but we have to start with that, and I think that is the way forward that we need also within our organizations as well.
I'm happy to have a go. Firstly, I think you've asked like the $1 trillion question, right? Like I don't think anyone has an answer to that excellent question that you've posed. But I would offer a couple of things. Firstly, I think there does need to be clearly a realignment of that incentive structure of those investment horizons within the asset management industry. I don't know how you do that. I would love to hear from you about what you think. I would love to talk to people in the asset management industry. I do think that there is an overdue conversation between asset owners and asset managers, like a very honest conversation about some of these things and how we do this together in partnership, because we are in partnership. But the second thing I would say is there are some basic economic facts about the oil and gas industry that a lot of investors aren't grasping yet. Like, yes, fundamentally they have delivered, bumper profits in the last sort of period. But if you look at a lot of the projects and actually stress test them economically, particularly where you apply climate constraints, and fundamentally, we've got 40-degree days going on in half of Southern Europe at the moment. I think it's going to be hard for some of those companies to keep their social license to operate into the 2030s when we're getting really severe climate disasters all over the world. I think that's going to be tricky for them. Plus, this is not a low-cost industry. It is not actually, obviously the price for oil and gas is high at the moment, but it is not going to be forever. And I also think once we start applying those climate constraints, which will come with continued climate disasters, I think it is going to be harder and harder for those companies to deliver the profits that they are delivering now. And I think if you even do some basic stress tests on some of the projects that companies are looking at opening up now, many of them are high-cost projects. I think we're going to see some of those companies collapse. Like, that is my sense. But, you know, if we had a crystal ball about what's coming in terms of climate policy, we'd all be in a better place, right? But I think that's, there's a few different dynamics there.
Just a quick point, which is a bit of an old chestnut, but I think it needs to be said, which is that trustees of pension schemes or pension scheme boards operate within a legal framework, fiduciary duty, that just isn't fit for purpose anymore in a world of systemic risks. I think it's just really, really need to open up the idea that you still have, as a trustee, a fiduciary obligation to act in the best interest of beneficiaries. But if you constantly privilege financial return over impact considerations structurally in the law, then it becomes impossible for trustees to actually do the best by beneficiaries. So I think we need legal reform that liberates trustees to weigh up risk, return, and impact. And in a world where 2022 sees stock prices of oil and gas companies go through the roof, trustees literally think they'll be the wrong side of the law if they weren't holding stocks that are long-term really damaging to their beneficiaries. That's an impossible and horrible position to put trustees into. So we think we need legal reform to unlock and open up fiduciary duty, still exclusively about the best interests of beneficiaries, but allowing this balance between risk, return, and impact.
Good point, and it reminds me of some UK pension funds divesting from tobacco for financial reasons. Because they couldn't say that it was for something else, which actually is total dishonest communication, actually, in my view. But anyway, there was a question by Bob. So there is an order. I don't know which order, but Bob is first. And yes, you determine the order. Yeah. Go ahead, Bob.
So just some quick color on Exxon and Engine No.1. I know the guy that ran that campaign. I've introduced him to Catherine. His name is Charlie Penner. And it wasn't a green campaign. It was a capital allocation campaign. For 10 years, their financial performance was going down. Mike Pence, former Vice President Mike Pence, wrote a famous op-ed piece in the Wall Street Journal. He talked about ESG as this pernicious strategy of progressives. And Engine No.1 always gets featured in these anti-ESG things. And he talks about, and this guy, Charlie, was from like a classic activist hedge fund, put 3 environmentalists on the board, undermining the company from within. Shocking. Who were these 3 people? They were people that had experience in the oil and gas industry, which ExxonMobil never had. So the CEO, the Imperial Combined Chairman CEO, could make whatever capital allocation decisions they wanted to make. So they put some on it. One is a guy named Greg Goff. I've gotten to know Greg quite well. Executive at ConocoPhillips, CEO of an oil and gas company, Republican, lives in Texas, gives a lot of money to the Republican Party. So we kind of laugh about the Mike Pence thing. I've done an interview with him. He thinks climate change is the existential issue facing our age. He will have different views than folks around here about how to address it. So the situation around this, I think, is quite complicated. So 2 quick questions. Ellen and I are always point counterpoint. First question, do you really think divestment changes behavior? And the second question is, do you think that the anti-ESG campaign in the United States could become a systemic risk? And a lot of that is happening because of folks like you. You are the reason a lot of this ESG pushback is happening in the United States. So are you creating a different systemic risk?
It's a great question, but you needed a lot of time for it, Bob. But it's a great question. Thank you. Go ahead.
Well, then
Anyway.
my question in return would be, could you elaborate a little bit more on this last systemic risk that you are referring to? How will that
Doesn't
evolve?
have a mic anymore. Well, I can walk to him. Yeah. Briefly, Bob.
You know, so very briefly, I mean, you've got this whole concern, it was in one of the panels yesterday, about greenwashing, as if you can have these enough pressure that is pushing back on what you're doing, whether it's Climate Action 100 Plus or it's GFANS, is that because of the way it's being communicated, because of the way that they're reacting, you've got people more concerned about the politics that they're dealing with and the political pressures in the United States, where most of the big asset managers are and where a lot of the big oil and gas companies are. And so it's making the situation worse at a system level because of the amount of assets that are involved and because of the political clout of the United States.
I can offer a few thoughts. I think it's an excellent point and question. So someone said to me recently, someone who's been in the responsible investment industry a long time, that firstly, like, this was inevitable and we should have seen it coming. And secondly, we probably could have taken more time to make the coherent, strong argument, we have all the evidence for it, there's no reason why we can't do this, for that economic case for 1.5. And I don't know that we've made that argument as clearly, like, I think, you know, we've built a bit of a house of cards in a sense, because I don't know that we built up that evidence base to the extent that we maybe could have. So I think there's that. I think the point that you made yesterday on the panel about the need to have conversations with people who have a different political thought process to you is really important. I'm very skilled at this. Christmas dinner, my dad's a climate denier. It's a great time, as you can imagine. So I think there's a couple of different things that we can do. And then I think on your point about divestment, I think anyone who really is passionate about engagement, believes it can work, struggles with the idea of divesting because, you know, you have those shareholder rights, you lose those shareholder rights. And I imagine that you guys are having that sort of, you know, conversation internally as well. But fundamentally, it does take huge resource. It does take a huge amount of time and effort and focus. And if you are invested in those companies, they're a huge risk to you, so you need to be engaging with them. So there's a few different things. I mean, I think having a coherent engagement process means that it is more meaningful. But the other thing is, we're at Oxford, so I'll say this, the academic literature on divestment doesn't have a lot of support for the cost of capital argument, which is the main one that people make. It doesn't really support that. I think it's a bit mixed. But the one thing it does say is that loudly divesting, which I'm glad to say that we did, can have an impact on those companies. So that's probably what I would say in terms of, does it have an impact? I mean, we moved a very small amount of capital out of those companies. I don't believe for a second that it affected them financially, but I do think it sends a very important policy signal, a market signal. It sends a signal to other investors. It sends a signal to the companies. They noticed. And how much does that matter? I don't know, but I think it does matter to an extent.
In the interest of having more questions, we go to the next, it's over there, and then we go here, and then we go to Sophie, and then over here, and not everybody will ask a question, I'm really sorry. They gave us only 75 minutes, so go ahead. Where are you? Yeah.
Thanks. Ben Cushing from the Sierra Club in the US. This is following up a little bit on Bob's question about the practical impact of equity divestment. If the goal is to change corporate behavior to reduce systemic risk, as I absolutely think it should be, why not focus on denying debt and stopping the flow of new capital to fossil fuels, but using your existing shareholder power to hold corporate boards accountable? I think it would not really require an intensive engagement program to adopt a policy to say, every year we're going to vote against the boards of fossil fuel companies that are misaligned, just pro forma, not putting any extra thought or staff attention into it. We're just going to vote against the boards every year for the next decade until they change, rather than divesting and losing that stake. But as you said, certainly focusing on supply chain companies and banks and stopping the flow of new capital, bonds and loans, new equity to the extent that that happens. I know Ellen and others have written about this kind of deny debt, engage equity frame, and I'm just wondering, why that approach was not taken by the Church Pension Board, and I think just to the last point you made about the impact on the social license and the media. I mean, I think if you look at the Exxon Engine No.1 example, that certainly generated a lot of media, getting board members voted against. So I guess this approach of denying debt, stopping the flow of new capital in the primary markets to misaligned companies, but using your shareholder power to vote against boards. Why would that approach not be more impactful?
Who starts?
Yeah, I mean, I think that question was directed to me. So yes, on the banks, you'll probably enjoy reading our climate action plan when it comes out in September. So we're planning to do that. That's part of our approach. And then on the voting against directors, you know, that was we did a 5-year engagement program with the companies, and that was part of our approach. You know, we voted against directors, we escalated publicly, we used a whole bunch of those tools in the toolbox, so.
But the point made is that you need to have also a share position when you are using the debt leverage, and you don't have that anymore.
Yeah, I mean, it's true. I mean, I think, as I said, you know, and I think everyone who is in the stewardship game knows that this work is really resource intensive. One of the things that I think is useful about our approach now is, you know, we spent 5 years doing this. It was very resource intensive. Now that we no longer are doing that, we actually have the capacity to go and have those conversations with other parts of the value chain. So yes, I think I can see your point, but there is a capacity issue around like how many companies you can engage with in a given period as well.
Can I just say, I think that's a very fair point, and to be, you know, a really coherent approach to escalation requires saying up front what we'll do when, if we don't get the results, and so it's absolutely critical to the credibility of the whole investment community that an institutional investor like the Church of England follows through. Otherwise, but I would completely agree that the denied debt thing is essential, and actually having been kind of generous about Climate Action 100 Plus because I think collaboration is really key, I would say that a critical design flaw in Climate Action 100 Plus from the get-go was that they didn't marry up equity and debt strategies, and that we had institutional investors who on the one hand had this engagement going on, and then they had, you know, colleagues in corporate debt portfolio managers who were just busy buying up the corporate issuance of those, debt issuance of those same companies. So a sort of real problem of incoherence, which is no doubt not lost on the finance directors of those said companies. So getting that coherent is, I hope, part of what Climate Action 100 Plus will do in its next phase.
I don't know, maybe there also will be a dark debt market that maybe does not really solve the problem at all, because maybe companies get the financing somewhere else. Anyway, not my thing. Yeah.
Hello, Josh. Hello. Josh Williams at File. So what does the panel think about getting board members nominated on public company boards after Exxon? Do we think it makes a difference? Do we think it works? What do we think of that as an engagement strategy?
I think most actors would see that as a pretty high escalation once all the other channels have no longer worked. The idea of forcing directors onto the board of a company is a step that many are not necessarily willing to take. And it takes a lot of steps: engagement with the company, voting against certain re-elections, and continued engagement over several years for that to happen. But it certainly should be in the toolkit if an asset manager or an asset owner with sustainability objectives that have some ambition, it certainly should be a tool in the box.
Hi, Diana George. I'm with University of Surrey and also Viva Investors on the macro stewardship team. My question is, so we talked about managing investee companies, but it looks like and seems like we might need a macro level change. If we're talking about macro level change, what do you think are the most important systemic changes that need to take place? And also, what can investors do to be effective and efficient in, you know, producing this change? Thank you.
I like these short, concise questions. Thank you.
Just a quick answer on that around the policy stuff. So I don't know if people are aware that yesterday, there was a very important, day before yesterday, very important vote in the European Commission, which will require European insurance companies to have net zero aligned transition plans. Also, European Commission, important vote about 3 weeks ago, the Corporate Sustainability Due Diligence Directive, which similarly will require 1.5 degree aligned transition plans from the corporate sector. These are critical policy developments, and it's just super, super important that all institutional investors that have come to the conclusion that policy matters get really vocally behind those kind of steps. Because I think where Europe leads, for all of Bob's points, and I acknowledge that, you know, US institutional investment assets are like, they just drown out everybody else in scale across the world. So it's a bit of a challenge, but I do think Europe has consistently shown policy leadership, and actually eventually the rest of the world, including the US, will catch up with the need for that. So I think that's a key place to go. And I'm really encouraged by what's happening at the EU level, and it deserves everyone's support.
Okay, so another answer? Yeah.
Come in and follow up on that. I think, yeah, you'd need policymakers to set transition goals for the economy that they're prepared to stick to and not backtrack on, so that everyone gets in line, says this is happening, and heads towards that particular goal. Because I think what we have at the moment, particularly in the US, is you've got this this slew of shareholder resolutions going through the system that are trying to do the work of regulation that some people wish existed but isn't there. And it isn't having the impact that it needs to have, because they can be voted against, there's limited support for it, and companies often actively oppose them. So it really is a case of that policy action. And so the financial community needs to engage with policymakers to say what objectives are they prepared to stick to.
Question at the back.
Thanks, Rob. Hi, Sarah Barker from Inter-Ellison. It seems like one of the good things that, let's call the anti-woke lobby, has done is to collectively engage with asset managers and banks and intermediaries, whereas the responsible investment community, we engage really well with individual companies. So in the context of the news this week that BlackRock has appointed the CEO of Aramco to the board of that company, A, what's our response to that? And B, do you think there's a need for better collective stewardship and engagement with the asset managers rather than the companies themselves?
I'm happy to take that. Excellent question, Sarah. And yes, absolutely. I think this has been a bit, there's been tension there, I think, for a long time because of all the things we've already talked about around kind of different investment horizons, different incentives. But I think what has happened is that tension has kind of turned from being a bit of a gap in terms of approaches between asset managers and owners, and it's really widening. And I think that requires a robust, consistent response. It requires a dedicated level of engagement. I think it requires both an internal approach, so really looking at your own asset managers, looking at how you set policies, how you set your mandates really thoughtfully, how you escalate with those managers where there is misalignment, but it also requires, I think, a collective response. And that is happening, right? So there are plans in Europe to start having roundtables between asset owners and managers to start having some of these discussions. I think it's really, really important.
I work in a global bank headquartered in Tokyo, a big Japanese bank that lends an awful lot to the oil and gas sector. I wanted to pick up on the point, Catherine, that you made about the kind of combination between equity and debt. So projects in the oil and gas sector are done with loans from banks to these special purpose vehicles, joint ventures. It's never to sort of one company. Whilst the driver for pension funds has been your beneficiaries, for banks that driver isn't there. Beyond the moral argument of not lending to the sector, what advice can you offer for banks lending into this sector?
It's such a great question, and actually the work that we have done as an organisation on banks, which is focused not on Japanese banks or US banks, but exclusively on the 25 largest listed banks in Europe, has organised institutional investors that have beneficiaries to push banks to make these commitments. And so the motivation and the pressure is coming from institutional investors and grounded in their duties or their sense of their objectives. And what I would say is that banks do need a social license to operate. So we've seen significant commitments from Barclays, HSBC, BNP Paribas, all to commit publicly to withdrawing fossil fuel financing arrangements. I mean, it's on a timetable and it's not perfect, it's not everything we want, but progress has been made. I think that largely, publicly listed banks should be subjectable to some of this pressure on the basis that their largest institutional investors have these duties to their beneficiaries. So we just have to link the chain up, if you like, or that's the way we've seen it. But it's a great challenge.
I'd love to talk to you about this afterwards if you have time, because I'd be really interested in your view on how pension funds can more effectively do exactly what Catherine said, you know, help, because I think we've made the case, but I don't think we've actually linked everything up yet, and I would love to figure out how we do that.
It's great. The audience learns from you, and you learn from the audience. It's perfect. So I have a question. I have actually two topics I want to throw in before I give the last question to, of course, the engagement lead of the Sustainable Finance Group of Oxford. But two topics. First topic is I heard the word beneficiaries a lot. How do you use your beneficiaries' views, beliefs, preferences in the choosing of which topics to go for or not? That's one. The second is, I hear the word resource a lot. So my question is, why does the institutional asset ownership not go beyond collaborative vehicles with a lot of talking, traveling, etc., but really creating toolkits that are deeper than they are right now with storing data, so essentially putting way more money in it and maybe financing it with all the fees you pay to all those active management organizations that do not produce an outperformance anyway. So, two things. And you can choose which one to answer, which signals something, by the way. So you can also choose to answer both.
Yeah, well, a short one on your first question. It's indeed the case that we ask participants on preferences in a structured way. And at the same time, you have to be very careful with that as well, because the way you frame the questions, etc., etc. So short answer there, we do that. But ultimately, it's, I think, the board of directors being responsible for taking out of the information that they want to use. With respect to the second one, that was one of the, well, the key messages that I gave at the beginning. I think we're just at the beginning of a journey on engagement. We learned a lot over the last couple of years, but going forward, when it comes to resources, I mentioned systems, data, etc., etc., we're certainly open to much more cooperation in that field as well. And, well, to pay lower fees to the asset managers to support that, I think it's an excellent idea.
Anyone else? Yeah,
yeah, I mean, I'm happy to add to that. I think on the resourcing thing, one thing that I think it's just worth noting is that most pension funds don't have many resources for this. You know, asset managers have larger RI teams typically, and often have, you know, relatively well-resourced stewardship teams. There's never enough resourcing for stewardship though, right? Like, there's only so many companies one person can cover. But the fact that we're a 3.2 billion pension fund, we're tiny, and I have basically a job that's dedicated to climate stewardship is extraordinary. Like, it's very unusual to have that kind of resourcing, so we're very, very lucky. I'm not entirely sure how you get beyond that. Like, it's a real challenge in this industry, but I think part of it is about just being smart and being really focused. And I've completely forgotten the first part of the question, sorry.
I think it's very important in your case, it's the beneficiaries. I guess you told me that they, yeah. So I think they fully are in support of what you're doing. Do you measure that? How do you measure that? Geraldine already said, yeah, you can send out a survey and you get some socially desirable answers or some dispersed answers. There are smarter ways of doing that. I mean, it's a bad example in the UK, but you can do a citizen assembly and ask them whether they want to leave the UK, yes or no. Well, then you get an answer, but you can also bring all your participants into such an assembly and just hear the unheard voices, maybe even voices against what you think that you should do, which really helps you. So have you thought about that?
I mean, we have quite an unusual situation, I would say, being, you know, part of the Church of England. So there is something that people from the UK have probably heard of. I hadn't when I turned up here. Stephen, who's in the audience, had to explain the entire thing to me, which is there's like a church parliament that come together twice a year and they have discussions about a whole range of topics related to the church. One of them is how the investing bodies go about their work. So we certainly take a lot of feedback from that group. And the other thing is we have an ethical advisory committee that have a combination of thinking about the ethics of investment, but they also interpret scripture and they look at, you know, what the religious teachings are within the tradition of the Church of England and help provide us advice that helps us do our jobs. Plus, in addition to that, we do a lot of engagement with our beneficiaries as well. And, you know, they're not afraid to tell us what they think, right? Like, this is a very active group of beneficiaries, as you can imagine, and like rightly so. This is their money. They have their own personal beliefs about where it should be invested, and I think that is a very healthy, good part of the pension sector globally, particularly where you have a pension fund that has a very clear set of beneficiaries that have a cohesive set of views. Like, I think that's a real power that we have in our industry.
Lindsay, what about the mutual fund sector? Because in Europe, they now have to ask for preferences if they do wealth management for individuals. How do they deal with that? Any
I
clue?
think everyone's still getting their act together on that.
Yeah,
I think
yeah,
there's a need for some honest discussion of the benefits, the objectives, and especially the trade-offs when talking about these kinds of things. Because in the example you mentioned, it is possible to get some weird outcomes if you just go out and ask people what they want without that kind of information flow. So I think there's plenty that still needs to be done on disclosures. In the UK, we're lucky enough to have the stewardship code, which has kind of pushed practice forward on those sorts of things. But the disclosures that an individual would need to make an informed decision are still kind of here, there, and everywhere under various different disclosure regimes. So to the extent that we can pull that together and harmonise it, that will certainly be helpful.
Actually, in the text for IORP, which is the European Occupational Pension Fund Directive, asking your beneficiaries what they want in one way or the other is now in the text for consultation. So it's coming to you. You can prepare for it in the best possible way. Catherine, you last, and then we go to the last question.
So just really quickly on this resourcing question. So I hope I'm not speaking out of turn, but there's some really interesting work going on by Willis Towers Watson with PRI, which I think is going to indicate that it would be really rational for institutional investors to ramp up the spend on stewardship by multiple of 10. And that would actually deliver really great outcomes. We're not even in the ballpark of what would be really rational and helpful. So that's on that. And then on this question of kind of beneficiaries' views, I actually used the word beneficiaries. It's actually an incredibly kind of patronizing 19th century type word, which sort of conjures up pathetic widows and orphans. I mean, these are working people whose own money goes into these schemes, who often, in the case of defined contribution schemes, are taking all the investment risk, and yet somehow they're not fit to be asked their views on some of this stuff. So one of the few schemes that does it, which is brilliant, is Railpen, in the UK anyway. Obviously, we love what the Dutch schemes do. They're much more beneficiary-centric and member-centric. But Railpen, Railways Pension Scheme, which is, of course, one of the old-fashioned schemes that have trade union officials on the board, do ask their members, and up come these really strong social preferences around fairness at work. They're really interested in how companies treat workers and things like living wage, climate also of really high concern. And that, of course, gives the investment teams a mandate for really ambitious stewardship. So I think there's this link between engaging the members, relating in stewardship to their priorities, and then having, as you know, when you go in and talk to those investee companies, if you know your beneficiaries have really given you a mandate, it's only going to strengthen the outcomes you can achieve, I think.
The last question.
Thank you. Krista Haltonen, Oxford. I'm going to ask a high-level question. So we've heard that despite limitations, engagement can be effective. I would like to know how you define effective engagement and how investors are meant to measure and know whether engagement is actually worth it in the end.
I'm happy to take that. I think you have to clearly define the objectives. You have to clearly define the companies you want to engage with first, why you're engaging them. You have to have a very clear rationale for that, the theory of change behind that. And then you need to have very clear granular objectives. They need to be time-bound. I always like to think like engagement without consequences is just a chat, and who cares? So you need to have really clearly defined timeframes, consequences, escalation, and then I think you need to be transparent about what you've achieved. You know, I think most investors could improve substantially on that level of transparency. That's a real challenge, and I think partly it's a resourcing challenge, but I think that having that coherent from the beginning of basic theory of change right up until this is what we achieved, these are the outcomes we got, and this is how we link it back to our engagement, that is what, you know, that good strategy looks like.
I fully subscribe to what you just mentioned, and two additions here. I think one, it's important to set the goals in cooperation with the company that you're engaging with, because that makes it much stronger. And the second one is focus on issues that are material, and it can be in different ways, but that improves the effectiveness as well.
Just going to completely agree with what everyone said. I think Laura covered some of the points that the Investor Forum wrote in their excellent paper a couple of years ago on engagement. But it's also important for those doing that engagement to find some way to communicate with their stakeholders at appropriate times, subject to what remains confidential, but to communicate with their stakeholders exactly how that engagement went, whether something failed, why, and what they've done about it to ensure there's that alignment and consistency.
Yeah, totally agree. It's not rocket science. It's just good project management. It's good monitoring, evaluation, and learning. All the tools are out there to do this well. I think it's a bit of a myth that circulates around this, that somehow it's impossible to capture clear outcomes. It definitely is, and we're doing it all the time.
So panel, essentially, I really would like to thank you for an honest contribution. It's not like you're selling something and there's maybe coincidentally no asset manager on the table, but still really nice. And secondly, I also think, although you weren't there, Geraldine, that you really listened well to Anne Simpson, that you thought about what would the 102-year-old queen said to you. Think about the unthinkable, the undoable, what was it? The impossible, whatever. You're thinking about that. There's a lot of desire versus reality type of trade-offs going on, but I think you're on the right path, and it gave me at least a lot of insights, and I hope also the audience. So with that, I want to thank you for your engaging questions, and especially the panel, and close this session. Thank you.